we have to look at the overall picture of what happens with investing. And investing is a long-term game. But at the same time, I think you need to be aware that investing is also a short-term understanding of what's going on in the markets. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to the show. I'm your host, Todd Dexheimer, and here's another solo episode. So I want to be talking about timing the market. I actually posted on, I think it was on Facebook, and I posted about investing in the stock market versus real estate, which is what I talked about a couple of weeks ago. Investing in the stock market provides pretty good returns, quite frankly. If you invest in the S&P over the last 25 years or so, you've done well. If as you go back a little farther than that, if we take a big history snapshot and we go S&P long term, 50 years plus, you're looking at like 8 to, I think it's like 9%, which is pretty good, right? And if you're coming up in a little shorter time period, you can get better than that. If we go, what's the S&P down from, call it the last 10 years, right? So 2016 to 2026, what's it done? What's done really well then? It's done like 13 or 14%. But also, if you look at it and go, okay, what's it done long term? Again, it's like 9, 10%. Okay, so good, still really good. Then we look at real estate and we look at what that's done. And like I said last week, or 2 weeks ago, it's better, right? It's you should be able to average around that 15%, maybe a little higher, maybe a little less, depending on exactly what you're investing in. But if we just go simply REITs versus S&P, REITs beat the S&P. But if you're doing it yourself or you're investing in a syndication, again, you should be able to even beat that. But there is certainly more risk. So you're no longer publicly traded. So there's many things to look at. That's not the point of today's episode. But the point of today's episode is when I posted that, somebody responded back and said, well, the S&P, if you invested over the last 10 years, you've done really well and you've averaged like around 14%. And I'm going, well, that's true. But if you invested in the S&P from 2000 to 2010, you made negative 1% annually. So we can take any snapshot and cherry pick investments and make it look fantastic or make it look horrible. I could sit here on this podcast and tell you, look, don't invest in the stock market. Look at what the S&P did from 2000 to 2010. Everybody lost money on it. And it took until from that crash in 2000, the .com, I think it was until 2015 or 2016 that it actually fully recovered and you were now finally ahead of the game. So yeah, we could take that snapshot and we could go, look, worst investment in the world. Don't even think about it. Or we could be realistic and go, look, over the long term, we're still doing pretty good, right? You just got to be patient. Same thing we can do with real estate. Look, if you invested in real estate in 2007 at the peak of the last market, and you invested, single family, even multifamily, office, industrial, whatever. But if you invested in the peak of the market in 2007, all the way through that 10-year period of time until about 2017, you really made next to nothing, depending on exactly what you invested in and all that kind of stuff. But if you invested it throughout the market, you didn't really make much money. Okay. You probably broke even, maybe made a couple bucks. You paid off some principal, which was good if you had a mortgage, but that's if you could continue to make the payments because, a lot of people were getting foreclosed on. So yeah, some benefits, certainly some tax benefits. You could have paid off some principal reduction with your mortgage and all that kind of stuff if you made it through. But again, now, so that's, call it flat, call it nothing. That's like the .com bust. Okay, well, what if we invested in uh, 2012 all the way through 2022? Well, if you invested in real estate from between 2012 and 2022, I would hope that you made at least 25% on your money. You better have made an average annual return of 25% on your money. Otherwise, you did poorly, right? So, look, again, it's private markets. It's different. I can't give you what the actual market did because there's so many factors to it. But most people average annual returns 25, 35, 45, 50%, right? So big annualized returns. They're making maybe not 50% if you're really looking at a 10-year period of time. But my point here is we have to look at the overall picture of what happens with investing. And investing is a long term game. But at the same time, I think you need to be aware that investing is also a short term understanding of what's going on in the markets. So for me, looking back and a lot of this is a lesson that I've learned that I hope to take with me through the next cycle. Um, Look, I made a ton of money buying properties and from 2008 through 2020, 2019, call it. Okay, I made a ton of money on that big upswing. I bought at the bottom and I continued to buy and buy and buy and buy. The biggest amount of money I made was at the bottom. Buying at the bottom allowed me to really expand. And when I look at the returns I made, they were ridiculous, but I was active, right? I'm actively doing this stuff. I'm not passively investing, but I'm very actively investing and was able to take 15, roughly $15,000 and turn it into a multi-million dollar portfolio. And that was through the bottom, from the bottom. And so that was through timing the market. Now, if I look at then what happened in 2022 in multifamily specifically, single family didn't go through the same thing. But in 2022, multifamily went through a bit of a reckoning and really most commercial real estate. And so with the equity that I lost, you know, if I purchased something in 2022, 2021, even 2020, the equity that was lost between 2022 and 2025, 26 as it were sitting today, was roughly about 20% across the board if we're averaging out what multifamily values lost. And so you lost about 25% of your equity. Now that's a significant loss, an annualized loss. It's not annualized 25%, but it's a total of 25%. So if we look at that, we go, okay, well, we lost money. Now, if we forward this out for the next couple years, 4 more years, I would guess it's going to be a lost decade, right? A decade where if you bought in 2022 and you sold in 2032, you made next to nothing. Okay. You might make a couple bucks, you might lose a couple of bucks, but you made next to nothing. That's what we call lost decade. Now, how can you use this to your advantage? Okay. Well, it sounds really simple, but in practice, it's difficult because there's a lot involved here. But it's about timing the markets and it's about figuring out when is the market frothy and when is the market scared. Okay, so let's look back a little bit. So the market was really frothy in 2006 and 2007, 2005, right through about 2007. I remember looking at houses during that time and everybody was buying a house. Everybody could get a mortgage. We got qualified. My wife and I got qualified to buy a house for, I can't remember what it was, call it $285,000. We had no business buying a house for $285,000. We didn't, happily. We were smart enough to see, like, look, this is our income. Like, it's stretching ourselves if we buy this house for I think it was like $160,000 somewhere around there. Maybe it was even less than that. So we're stretching if we buy this. So let's be cautious about what we buy. We can't afford this big expensive mortgage. That would be stupid. And I'm happy we had that common sense and did that because we would have been in trouble. That same kind of thing happened in 2020, 2021, 2022 in commercial real estate. Everybody was a commercial real estate investor. Everybody was an apartment investor. Everybody became overnight success, right? They were teaching courses that, look, there's a local group here. They were teaching people how to raise money and buy apartment buildings. And like they had almost no experience, right? They just learned how to do it. And guess what? They've lost everything now. So that happens. And so we have to look out for that. And we have to think, how is the market being frothy? Well, do the fundamentals work? If anything happens, what happens to the market? Not saying if the worst case scenario, because look, you could scare yourself and say, well, shoot, if anything happens, well, what if World War III breaks out? Well, of course, things are going to get bad, right? But we have to look at the fundamentals and just think about what's going on with the market. Is just say, look, like reality says, if a few things go wrong, and very minor things, then all of a sudden the market loses value, and I'm stuck with these properties. I I should probably bow out of this market. Again, it's frothy. Everybody's an overnight success. Everybody's talking about it. Everybody's doing it. Okay, I maybe should back off a little bit. It doesn't mean you sell your entire portfolio. Probably not. But does it mean you look at your portfolio strategically, maybe exit some properties, um, look at how you're repositioning your properties, look at your financing of your properties, those types of things? I think absolutely 100%. Like that's what you need to do when the market gets frothy. Take some chips off the table, take risk off the table. And so looking back, if you were in, and I wasn't in the market in 2005, 2006, 2007, but if you were in that market 2005, 6, and 7, you probably should stop buying properties, right? And you should probably reposition your current portfolio. So whether that's selling some assets, maybe that's refinancing some assets into long-term fixed debt because you know something could happen here. Those are positive things. Now, what happens if you time it too early? That's always a risk. You got to be patient and willing to take that bet. But it doesn't mean that you can't continue to buy. You just have to buy again cautiously and thoughtfully on how you're going to do that, and know that you could lose out on a lot of equity if you were potentially right, and then you decide you're going to be impatient and go buy. Same thing, 2020, 2021, 2022, like, boy, take some chips off the table, refinance those properties that were in floating debt or, even fixed debt, but the term was running light on it. Well, you refinance that, put that in long-term debt, get some equity, make sure you're in a good cash position to be able to handle what's potentially coming. And if you would have done that, you'd have been doing really well today. Now, what happens on the down cycle? And I think this is where more millionaires are made than anything, is on the down cycle. You need to be ready to buy. Down cycles are challenging because we don't know when the bottom is. We don't know if we're truly at the bottom. Now, I think 2008, 9, 10 was a little bit easier because we saw such a drastic drop in pricing. We knew that, man, these deals just make so much sense, right? Like it just was like fundamentally, it made a ton of sense. Now, early on, it was still challenging, and I'll say it definitely was challenging. A lot of people didn't get into it because they didn't know you're catching this falling knife, right? And they didn't know if they were going to buy something. What was the value going to be? And you didn't know when the market was going to recover. So when I first started buying in 2008, 2009, even 2010, 2011, man, I'm buying these rental properties, but tenants aren't wanting to pay rent. You're evicting tenants. I evicted a lot more tenants back in that era because they couldn't afford to pay rent. They lost their jobs, whatever it was. They either left or had to get evicted. Now, it wasn't like it was a crazy amount, but I didn't have a crazy amount of properties. So if you had apartment buildings, and especially in areas that more like C class, where people were losing their job like crazy, Yeah, you had problems and potentially issues paying the mortgage because so many people were getting evicted. Um, but if you bought it right, you probably did okay and you were able to weather through that storm. Now, if you bought in 2006 and for the top of the market, that's where you got in trouble. Um, but again, timing the bottom and timing the top are always challenging. I think the easiest way to think about timing top is if, and this is easier in stocks than it is in real estate because stocks are, quick moving, where real estate's very slow moving. And so when it changes, you still don't know if it's truly a change. You can't see it in real time almost. It's like, okay, values are going down, but by the time you really realize it, the values have already gone down 10, 15%, right? And you're like, oh, value, oh, shoot, we passed the peak. Where in stocks, I feel like, man, it happens really quickly. A lot of times, if you're on top of it, you can time it pretty quick. But if you can wait until the values just start to lose a little bit and then exit or refinance or kind of reconfigure your portfolio, that's the best way. Again, that's challenging. Um, Same thing with the bottom. Like if you can wait until it's truly bottoming out, certainly the best way. But in practicality, it's about reading the market as best you can. It's about understanding that I wouldn't put all my chips on the table either. Like I wouldn't say I'm going to time the market every single time and sell 100% of my properties, or go all in and buy every single property I can find in the market and be low on cash because I want to be high on equity, thinking that I'm timing the market. Like I still think you got to be super cautious about what you do, but again, take some chips off the table and understand where the timing is the market, or add some risk to the table when you feel like it's a good time to get in. I think right now is a challenging and a difficult time because what I feel is, man, the market went down pretty considerably, 25% multifamily. So it feels like it should be the bottom, right? It feels like opportunity should be out there everywhere, but there is very few opportunities right now. It's really hard to find a good deal. And so are we at the bottom? There is all this potential distress that's coming. We don't know, but people keep talking about it. There's a lot of people that have these mortgages out there that are outstanding. Like, so does that distress make a new bottom? And should that be when I'm waiting to buy? So what are we doing right now? Look, we think this could be the bottom potentially. So we are buying because we know it's less than the top. And what we are doing, and this is always prudent, right? No matter what cycle of the market you're in, we are putting fixed rate debt on things. We are focusing on cash flow properties. We are looking at these deals. How do they line up for us on the short term and on the long term? And those are the properties we're focusing on buying. Do we want to own these deals today? And do we want to own these deals potentially over the next 10 years? Because look, if we aren't at the bottom and we still continue to drop and go down, but we want to be prepared for that. So that's, I think, in my opinion, the best strategy for a down cycle. And even quite frankly, for an up cycle is you want to make sure that these properties are positioned well to succeed in the future, no matter what really happens and takes place. So time the market, but don't paralyze yourself by needing to time the market, right? I think there's always opportunities to look at purchasing assets. Uh, you just have to think about it differently in different parts of the market cycle and in what is taking place. within that market cycle. Like you could have bought in 2022, and we did. We bought several assets in 2021 and 2022 towards the top of the market that we bought well. We bought it with fixed rate debt. We bought in good locations with the value add story. Like all of those things lined up really well with a lot of equity. And now those properties are doing really well. I mean, we have one that is absolutely fantastic. We have a couple that are doing good. But if you bought with a strategy of this market's going to go up forever, that's where you got stuck. And that's where plenty of people got into trouble, is buying thinking that we're not in a market cycle. It's always a good time to buy. We got to just buy, right? Because it's always a good time to buy. All right. I hope this helps. I know as I'm talking through it, I'm like, am I just confusing myself more than anything? But hopefully it helps. It's difficult to be in, but I think it's just really good to always be thinking about where you are in the market and what are your strategies to succeed in the market cycle that you're in. And boy, man, when it gets so frothy, like it was in 2026, like it was in 2022, it's time to take a step back and realize that it might be the peak. And I think the same thing is happening in the stock market. Quite frankly, we talked about the S&P to start. In my opinion, we're going to have another lost decade. I don't know when it's going to be. Is it going to start in 2026? Going to start in 2027? Maybe it's going to start in 2028, but I feel like I know it's going to start fairly soon. And by soon, I mean within the next couple of years. And we're going to have a lost decade in the S&P again. So that's just my opinion. I'm not your financial advisor. So do what you want with your money. It's not my money. It's your money. Do what you need. Take care.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.